Welcome, I'm Catherine Magana here with Steve Wolf, Greg Carroll, and Vince Stefano, where we're here to provide you some insights about the market and planning. So over the last week, as we kind of reflect on the markets and what's happening, the markets have been up a little bit this week, and the most movement I've seen is in the Russell 2000. So the small caps have actually moved up. Today's October 17th, but as of yesterday's close, it looks like the small cap stocks were up over 4%. So they've been lagging a little bit from some of the large cap stocks, but obviously they've come up a little bit this last week. The other thing we keep hearing about is the Fed. That looks like the Fed is going to have another meeting in November, and the likely of them doing another rate decrease, it looks like the probability of that is about 85% chance, whereas yesterday it was a 96% chance. So who knows? Anything could happen between now and then, but it does look like potentially another rate cut between now and the end of the year.
I was going to, touch on that a little bit because, as you mentioned, the markets have kind of, ticked up quite nicely. A lot of the indices were hitting, new highs, all-time highs. But, we're getting to that point in the year where, you kind of move into the very positive uptrend season of the market. And, we've got two things on the horizon. You just mentioned interest rates, which I do believe the Fed's going to take it down another 25 basis points. And we've got the presidential election coming up. So, within a couple of weeks, we'll figure out, what's going to happen there. But I think on a more interesting topic, and we've talked about this quite a while, we talk about a lot about trends and, where the market may be going. But one of the trends that I'm really starting to see big time is the market's focusing on nuclear power stocks. And I'm going to touch on this just because many mega cap tech companies that with huge AI investments need a very stable amount of power to run these. And so what they're doing is they're turning to nuclear power stocks, whether it's small nuclear reactors or even big cap mega techs are looking to recommission nuclear power plants because they want to put their data centers very close to where this power source is. They figure it's a much more consistent, safer power source than some of the grid they need. They can't really run these databases off wind and solar, so they need something that's really much larger. Other thing, we're in the early innings of third quarter earnings season. So far, the big financial companies have reported and pretty much in line. Net interest margins were very attractive. Trading, because the markets have gone up quite nicely, trading volumes have increased dramatically at some of these firms. And now what they're saying is look for iBanking business to pick up in 2025. So, hey, that'll be good. Get more liquidity in the market. And the wealth management business has done quite well at some of these major firms. Next week, we've got the big industrial companies reporting. The week after that, the 28th, is when the big mega cap tech stocks start reporting. So, that'll be quite interesting to see how they've done. And my last point is, if the Fed does cut 25, which everybody thinks they're going to, CD and bond rates are most likely going to come down a bit. And people have been really enjoying the 5% plus rates they're getting in CDs and money market funds. With another 25 basis point rate cut, you may see rates come down under 4%, which isn't all that attractive. So if you're a big CD owner and you've got a lot of money in these fixed income instruments, you may be looking to move your money into other investments, reinvest possibly into equities. If you do, my only advice is to stay in very large cap companies because you're going to need liquidity. And stay with these large companies, keep the liquidity, and you're also going to get some sort of dividend payout, which could match what you're getting in your money market or CD accounts.
Well, we just looked this morning at the rates on Treasury bills and also money markets. They're already have come down. Where you were getting 5 to 5.25, maybe 3-4 weeks ago. Right now, in a Treasury bill for 3 months, we saw, I believe it was 4.6%, something in that range, and the money markets are similarly down. So it's already coming down, and if the rates keep coming down, then those things will come down. Obviously, money markets still, look, for a money market, if you're getting 4.5% is just a resting place, it's still not bad. Not too long ago, you were getting 0. So 4.5% is still not bad if you need the money for something else. But as far as an investment, kind of agree with you, Vince, that there are other things that you can do that could get you more than that 4.5%.
I don't know about CD rates, but I'm assuming they're coming down along with the money markets and the
Right.
and the bond rates.
I suppose if somebody looks, far and wide, they probably can find some CD rates that are higher, usually from banks that need money for whatever reason. Maybe they're in trouble. But, when the market is at 4.5% and you see a teaser rate at 6.5%, 7%, you got to kind of ask yourself, why are they doing that?
And then I've also seen some CDs where you have to make sure, are they callable? Because some of these rates they're actually callable. So you have to make sure, am I in an actual CD to maturity, or does it have an option to be called?
I think the amazing thing is that, there's been a ton of bad news, or indeterminate news, something like who's going to win the election. But the wars that are going, and it's just everything. It seems like there's been a lot of bad news, yet the markets still have gone up this year. You said October, November, December is usually a good season. Really, this whole year has pretty much been a good season for stocks.
Yeah, we're up 23 and change on the S&P year to date. We did 26 last year. That's a pretty good follow-up to a 26% upside in the S&P. And to Catherine's point, the Russell 2000, I think we're finally, it's starting to catch up a little bit, but we're only at highs that we last saw in 2021. So the Russell 2000 has really lagged a long time, ever since COVID. So it will be interesting to see if that continues to broaden out and play a little more catch-up.
The thing about the Russell 2000, the significant amount of stocks in the Russell 2000 are in very small energy and financial companies. So until those smaller energy and financial companies start to look much better to investors, the Russell will trail the S&P because people are going to liquidity in larger cap names.
Yeah, but that doesn't last forever. Just like everything else, And when the small stocks get cheap enough, and they have been cheap in comparison to the larger companies on the PE basis and those types of things, then people look for the bargains, and if the bargains are in small caps, that's where they're going to go. I'm not saying they will, but that's always a possibility. By the way, it also brings me to my weekly fear and greed index, which is teetering between greed and extreme greed. And it's interesting, too, because when we're opening up accounts right now, a lot of times we'll tell people, well, we don't want to put everything in just at the moment. And the clients are kind of pushing back and say, well, you have to put everything. Look how great the market's doing. Yet when the market is down, when things are really on sale and they say, well, why are you putting it all in? Because the market's bad. Again, that's the opposite of what we should be thinking. Okay, if markets are really high and very expensive, and they're starting to get that way as an overall market is concerned, not individual stocks per se, you have to be a little bit more cautious. So that's kind of a lesson in how to make money in the stock market and not lose a lot of money.
You're still seeing a lot of the big tech names, some other of the top 7 or 10 stocks that have really carried this market the last couple of years, but they are expensive. But to Vince's point, he always says, that these guys are the ones that have the earnings and the cash flow, and there's a lot of momentum there. But I really think that, like you said, Steve, that the rest of the markets, the money is going to start finding its way out to better values when I think the Russell's only at like 14 or 15 times earnings, and the S&P's at 21, 22. Longer term, that's probably a better opportunity.
Yeah, and we're not sitting here saying, just because like the Magnificent Seven has gone up a lot that you should just sell all of it.
Right.
But sometimes ringing the cash register is a good thing. When these companies make a lot and they're perceived to be expensive, and you look for some things that maybe aren't as expensive. We love a lot of those stocks that you're talking about, that like what you're saying, Vince, with large cap stocks. A lot of them are technology stocks, and we still think we're in the beginning stages of AI. So over the next 10 years or 15 years, but over the next 6 months, a year, who knows?
Now, tech is very directional, and as the market moves, up or down, tech is going to be moving the markets up, or tech is going to move the market down. So, you have to live with the volatility if you want the upside potential from technology names.
Right, and a lot of people say volatility equals risk. I am not one of those. To me, risk is what's the chances of losing all of your money, okay? if you look at some of these large names that you're talking about, you're not going to lose all your money. They're not going out of business, okay? But they are volatile. They go up and down a lot, so you have to be able, as you just said, you have to be able to live with that if you invest in those companies.
And I think we've talked about in the past, within a year, the S&P 500 can move negative and positive, and it can also move 25 to 50% in a year. So things do fluctuate. Individual positions fluctuate. It's just, once again, what's your core position and what's the purpose of those investments in your portfolio?
Spoken like a true financial planner.
Yes. Speaking of financial planning, my favorite topic, we do financial planning, and through the financial planning process, we do factor in, is there long-term care needs down the line, nursing care? We don't want to be blindsided later, so we want to have those conversations. But now we've been working with many of our clients for many years, and we actually see, that kind of that phase where there's that care that's needed, and it's expensive. So if you didn't plan and you need money, or if you did plan, we're here to help set those things up. We actually have a client that we've been working with for many years. She's in her mid-90s now. And she's recently now in a nursing home. Her sons are the trustees for her trust and are helping, and we're setting up money to go to her to her bank so she can pay for this nursing care. And it's not cheap. I mean, it could be $5,000, $10,000, $15,000
a month.
A month. Yes, a month.
Oh.
So once again, how is the money positioned? What's the purpose, and how we help set that up behind the scenes with them. And so it's one of these things that we sometimes think it's never going to happen. But it does happen, and it is part of life. And for some families, they decide, they're going to have in-home care, or maybe some of the family members are going to come in and take care, or they may have somebody, an in-home nurse, come in. But once again, there's a lot of costs that are associated with that. It looks like the cost for home health care has gone up 14.2% over the past year. And part of that is because there was also not a lot of, in-home care nurses and people available. So when you have a demand and you need something and you don't have that, then obviously the costs can go up. But that's definitely part of planning and looking at what are the costs. And this is something we do see. Obviously, we love the weddings and the grandkids and all the fun stuff. But obviously there's the part of life
Isn't there long-term care insurance that people buy to cover all those costs?
So there is some long-term care insurance, and there's long-term care insurance. There's life insurance with long-term care insurance riders. But there's also some, a lot of clients that can self-insure, so they have enough assets to cover. So it's just a combination of figuring out what's best for their situation.
And the straight long-term care insurance has gotten so expensive.
Oh, has it?
Yeah, a lot of the insurers got out of the business because they were losing money. So it's straight long-term care insurance, yes, it's there, but we have found that it's pretty expensive, and found maybe some better ideas with the long-term care rider. So, but again, it depends on everyone's individual positions. But a lot of people can self-insure, and sometimes that's better. But $5,000 or $10,000 or $15,000—that's a lot of money. I mean, it's probably more than someone's alimony payment.
I don't think enough people, when I talk to them about financial planning, and we start talking about the medical expenses that they might experience, and even when you think you've got Medicare coming up at age 65. That covers some of your doctors and some of your hospital stuff, but it doesn't, cover vision, hearing, dental care, prescription drugs, and a lot of retirees travel. It does not cover you in, outside the U.S. So, medical planning and healthcare planning, I think, is one of the most almost ignored parts of most people's thought process when they go into retirement. So they really should be sitting down with a qualified planner to look at all the aspects of what they should be saving for.
Well, all I know is that when I get up in the morning and get out of bed, it takes me maybe about 30 seconds to a minute before the parts start actually moving. So I think that
it's a process.
As you get older, you really do start thinking about that. A bunch of us were playing golf yesterday, and we were just all laughing about all the maladies that we seem to have. Those people in our 70s and stuff. So
I think we were having that conversation before we started this today, too. The joys of getting older.
Yes. Well, hopefully we all get older, and as long as we're on the right side of the dirt, it's usually a good day.
Exactly.
So, well, that kind of takes us to the end of this podcast, and we'll see you guys next week. Thanks.
Thank you.
Please stay tuned for important regulatory disclosures. WWM Financial is an SEC-registered investment advisor. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry and how we may be able to assist. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. As always, please remember, investing involves risk and possible loss of principal capital. Tax considerations presented may not be appropriate for every individual circumstance. A tax professional should be consulted before making any decisions about your tax liability.